Hey guys, what's happening? We're here for another live stream tonight. Going to talk about some dividend stocks and just kind of chill out, see what's happening in the market, and see if we can't get some returns going this year. Things are looking actually pretty good. So tonight's topic is about risk-adjusted returns, and the question is, do they matter? And if they do, when do they matter? And how should we think about them? So we can toss that around. And then, I'd like to hear your thoughts on that as well, because it's probably a little different for everybody. There was a big rainstorm that just came through. And normally here, thunderstorms come from the west, like the southwest through the northeast. And this one actually came from the north. And the only times I've ever seen rainstorms come or thunderstorms come from the north, they have been tough. And so this was pretty tough. But so I was really hoping we didn't lose power. And, lo and behold, we didn't. So we're here and we are ready to roll, ready to talk about some dividend stocks tonight. Let's see who all is on the program. Let me know if you're here. We have ex-dividend dad is with us. Man, you must have gotten off early tonight, or maybe the kids don't have any ball games, or just one of those weird times, huh? Let's see. Ex-dividend dad says we need to look at risk-adjusted returns every day. Buy ETFs by great companies. Don't be afraid to sell them when their risk-adjusted returns aren't there. Yeah, so we'll talk about that here in a little bit. And this is really good advice. Be careful that you don't cut your flowers and water your weeds. That is good sage advice. I think that actually came from Peter Lynch, but we'll take it. That's good stuff. All right. Rust Moments is in North Carolina at the Billy Graham Cove Conference, and he's not going to be able to make it. But, man, I really appreciate you dropping in, letting us know that. I think you've been there before, if my memory's right. So sounds like you frequent there, and that's fantastic, man. Hope you have a great time at the conference, and we'll just catch you on the next one, man. It's good stuff. Kenji is here. Good to see you, buddy. Fenders 53, also known as AKA Mr. Income, is here. That's Jared. Hey everybody, that's Jared. It's good to have you, man. How about that WHR dividend cut? I saw that they had reported earnings, but I didn't see the dividend cut. We'll take a look at that here in a few minutes. So fortunately, I sold all of my Whirlpool shares. Probably, I don't know how long ago. We'll look that up too. I don't remember. Terry wants to know what we're sipping on tonight. So I will say that I got this Stanley cup for a gift. I don't remember for what purpose, but it is really big. It's really heavy. And in here, I have bought Milo tea. I bought a gallon of unsweet, a gallon of sweet. I basically pour half and half. So this is half and half iced tea. But I will say, my granddaughter was here just a few minutes ago, and they just left right before the broadcast. And she gave me a Bluey sticker for my cup. So I'm not taking that off. It may fall off eventually, but it's cool. Actually, that tea is really good, man. That's good stuff. So, Terry, that's what I'm sipping on. What are you sipping on, man? Hopefully it's good. So there must be something going on with the Bears. Michael Swami is here. Good to see you, my friend. Yes, it is a great mug, John. I have a John Deere tractor, and so I have a few acres that need to be cut, and I've been trying to catch up on that. I let it grow because of the flowers that were in there. I have a lot of clover and things like that grow in there, so I kind of let it grow so the bees would have food to eat. And now I'm back to cutting it, but it takes a while because it's so tall and thick that I had to run like in first gear the whole time. But I take this cup with me, and I have a cup holder on the fender of my John Deere. So I have a big blue cup and a big green tractor. So that's got to be a country song, man. We can make something up. But I haven't had it but just a few weeks, which makes me wonder why I got it. Might have been Father's Day. Yeah, I bet it was Father's Day. So anyhow, Legendary is here checking in. Hope everybody is doing all right tonight. Yes, sir, we are doing good. At least we're doing good on my end. Hope everybody else is doing well. Oh man. What do you like in this frothy market? Oh, that's a good question. Let's talk about that here in a little bit. I'll show you what I'm looking at. Nothing is happening with the Bears, which is why I feel. Yeah, so we know that Ex-Dividend Dad loves the Lions. So the Lions and the Bears just don't seem to get along. Fast Daddy is here. Good to see you, man. So it looks like I'm caught up here. So let's get started on risk-adjusted returns. What is it? Why do we care about it? Does it matter? And if so, when does it matter? And how should we think about it as investors? So here we go. I'm going to switch you guys over to, let me find this. There we go. Man, we are smoking tonight. Okay. Should I look at risk adjusted returns? That's a great question. So, one of the things that happens to us a lot of times, I know it happens to me, maybe it happens to you, is you say you think of something good or something that might have potential or something that needs to be done and something that would benefit your life, and so you say, you know what, I'm gonna do that when I get around to it. So when I get around to it, I'm gonna improve my portfolio when I get around to it. Well, I want to tell you that I found these on the internet, and so I'm sharing them with you. These are called round to it's. So this is a round to it. Guard it with your life. Now that you have a round to it of your own, you can accomplish all those things you put aside until you got around to it. So you guys have it. That's your permission to get started on whatever it is you said you're going to do when you get around to it. So there you go. It's good stuff, man. All right, risk-adjusted returns. What is it? So it's probably best to talk about the formula. The formula is this. It is the return of your investment minus a risk-free return. So what would I get as a return if I just put this in let's say a money market or some form of treasury bills? Maybe that's a better example. So your return minus the risk-free. So the risk-free, basically you have no capital at risk, right? You get a return, no capital at risk, and you can get that all day, every day with no risk, basically. So what is that minus what am I getting? And then you divide that by your standard deviation. And what that means is, if you're not mathematically inclined, standard deviation is the volatility of your portfolio. So basically what you're answering, the question you're answering with risk-adjusted return is what return in excess of what I could get just by putting it in a savings account somewhere. What return am I getting? And then what volatility am I experiencing? So they call it risk adjusted. Volatility has typically been a proxy for risk. It's not really risk, but it is a way to measure risk. Your volatility is a way to measure risk. So the way this formula works is, what return do I get per deviation? So per movement in the investment over time. So it's basically my return over the risk-free rate divided by how volatile my portfolio is. So let's take a look at this. I thought I would share with you this calculation. Now, I apologize. I didn't really get in here in time to kind of narrow these numbers down a little bit. There are a lot of numbers here. So I'm going to try to make this a little less complicated. Maybe I'll hide a few things. So maybe that's better. But basically what you see here at the top is the return. This is total return. So through July 25th, which was this past Friday, July 25th, the portfolio had 9.45% return, total return. The S&P 500 was right on our heels at 9.42. NASDAQ was a little bit ahead at 9.71. Dow Jones was trailing pretty good at 6.55%. And the Russell 2000 has really, they're positive this year, but they are actually lower than the risk-free rate. So that's not a good sign. And so this is, what is this? Oh, yeah. So you can see on here that basically we're 3 basis points higher than the S&P 500. We are 26 basis points lower than the NASDAQ. 290 basis points higher than the Dow, and 731 basis points ahead of the Russell 2000. So the portfolio is doing pretty well this year. But is that all that matters? Is it just about how much return am I getting? Because if that's all that mattered, why don't I just buy the riskiest stocks in the world and try to get the best return I can get? Well, I think the answer is because I could lose it all too, right? So here we go. We've calculated, I think I have 2 standard deviations here. So I did one on a year-to-date basis, and then one on a weekly basis. I think weekly is probably the right way to do it. So anyhow, the point is, here's the standard deviation for the portfolio, the S&P 500, NASDAQ, Dow Jones, and Russell. And here is my risk-adjusted returns. So basically, they're pretty high. But I mean, this doesn't mean that that's the return. It just means that this is how much return per standard deviation, or per tenth of a standard deviation, if that makes any sense. So how much how much return am I getting for volatility? And no, I said that wrong. This is the risk-adjusted return right here. This down here is the risk-adjusted return. So what I have here is the variance between the risk-adjusted return for my portfolio versus the risk-adjusted return for the S&P 500. And I do that also for the NASDAQ, for the Dow, and for the Russell 2000. You can see that in the prior week, which would have been the 9/18, this is the prior week here. You can see that the NASDAQ actually was beating us. And why is that? I mean, it hadn't beat us for quite a while. And then all of a sudden in that 1 week, we kind of lost our ground there. So now I'll show you why that is. So the NASDAQ from 7/11, it was 6.99%. It went to 8.6% on a year-to-date basis in that 1 week. We only moved maybe 0.4%. They moved like, almost 2%, 1.7 or some, whatever that is, 1.6%. And that was a big move, and it didn't move the volatility that much. So they ended up with a nice risk-adjusted return. But you'll see what happened the very next week. Our portfolio picked up, and they made about 0.9. We made almost 2%. And so we again began to smoke everybody on the risk-adjusted return. So why does this matter? And is this just a matter of mathematics, and so we don't really care? What is it? How do we look at this? Here's the way I think about it. I think if you are young, very young, just starting out, let's say, and you have very little in terms of portfolio, I don't think risk adjusted return matters to you at all. At least it didn't for me when I was a young warthog. You parents or grandparents will know what that is. So when I was young, I wanted to grow my portfolio, and I was willing to take the risk to do that. And you know what? It was fine. It was fine to do that. Um, Now, though, I'm not young anymore, and I'm also my portfolio is not small. So as my portfolio got bigger, I was less willing to put the portfolio at risk to try to get a rate of return. And so, what I would pass on to you guys, if it matters to you, is that if you have a small portfolio, you're just starting out, none of this really matters. If you are at a place where you have begun to build your portfolio and it is getting to be a pretty good size, like six figures or whatever, risk adjusted return begins to matter because you don't want to lose it all, right? And so you want to see how well am I doing in my returns versus the risk that I'm taking. So anyway, at this point in my life, it becomes more important. And I know I've mentioned many times that the volatility of my portfolio is less than what you'd find in the S&P 500. However, on a long-term basis, since 2021, our portfolio, the Wealth Circuit investing portfolio, has beat the S&P 500 overall, not just risk adjusted, but it has beat the S&P 500. That's at least a 4-year track record. That's all I got, because that's when I started this portfolio. It's when I retired. And so, but 4 years is a pretty good amount of time. So at the end of the day, that's where we are. So I think it's important. It's important for me because I like to sleep well at night. And, some of this is going to move on to the kids. So I want to still get a good return for them, but I also don't want to lose it. So it's about being risk adjusted. So, all right. Hopefully that, let me know if that matters to you guys at all. So I just went through about 15 minutes of discussion there. And I just want to make sure that it matters to you. So Fast Eddie, yeah, that's where we were. Okay, Hassan, good to see you, man. Hello to you as well. Yeah, that it is a dad joke. I think it was actually started. I remember, and guys, I know this is like a long time ago. Okay, I remember as a young boy going to my grandparents' house, and in the desk drawer, my grandfather at that particular time, he had many jobs in his life, but at that time he was an insurance salesman, so he did work at home, with policies and all that. So he had a desk and a little bedroom in the back of the house. So I would go in there as a young boy, probably 4, 5, 6 years old, and I would play around in that desk, looking at stuff, pens, and stuff like that. And in that desk was one of these round tuits, and I had forgotten about that until I saw that this week. So I thought I'd share that. But so I think Zig Ziglar is probably the one that came up with that, the round tuit. But you guys can check that out and see if that's true. And yeah, don't take any wooden nickels. That's a good sign. Billy Johnson, man, good morning to you. I know it is early where you are, but it is getting late here in Alabama. Yeah, so the Sharpe ratio is another risk-adjusted ratio. It's much more complicated, so I didn't want to kind of get into that here. But there are multiple risk calculations that you can look at. So, and the Sharpe ratio is another one. Yeah, keep it simple. 1 or above 1 is good. There you go. That's on the Sharpe ratio. Yep. So Fast Eddie says, what did you sell your Lamb Weston stock at? Had a jump up, but finished down today. Yeah, well, I tell you what, let's do this. If you guys don't care, we will look at transaction data. I'll just get you guys in the guts of this spreadsheet that I've set up. Lamb Weston. Whoops. Yeah, that's the one I want. So you can see everything here. I'll get rid of the dividends received. We'll just look at the buys and the sells. And then I'll get rid of that social media. All right. So that'll be a little bit better anyway. So you can see I bought Lamb Weston starting in June of 24 at $87, 87, then 82, 78, 77, 78, 77, and started selling it at 60 and bought more at 55 and sold everything, the rest of it at 59 and a half. So I ended up, let's see what I got here. It doesn't look right. Oh, yeah, it is. I lost $23,000 on that transaction, but I was glad to be out of it. So I sold it at 59 and a half. So let's do a quick look. Oops, that's not it. Let's do a quick look here at tip ranks and see what Lamb Weston is trading for now. I really don't track them anymore. I've taken them out of the spreadsheet as well. And I took them out of my spreadsheet because the management team just doesn't seem to get it. What in the world is all this? Okay, so yeah, they are down. They're roughly about a little lower than what I sold it at, even with the big jump. So I must have sold it like back in here. And then all of a sudden it was way down for a while. Then it jumped back up, and who knows? I think the biggest hope for Lamb Weston is getting bought out by somebody else and putting a management team in that knows how to run a business. I don't think these guys are very good at that. They just make mistake after mistake after mistake. And, life's too short. I don't need that. So I got rid of them, even pulled them out of I don't even track them anymore. So hopefully I'm not unclear about that. So anyhow, let's see what else we got going on here. Ex-Dividend Dad says, I personally wouldn't mind a small cap ETF now compared to buying SPY or QQQ. Yeah, it depends on how you look at it. Is the growth going to happen are you looking at that because you think it is undervalued, or are you looking at that because you think that's where the growth is going to come from? Is it going to replace the growth that we're seeing in Google, Microsoft, I'll even throw out Amphenol and Amazon, those guys so I think at least in the near and midterm we're still looking at growth coming from this high tech world. And I know the small caps can really move, but you have to be good, and an ETF might be the way to do that. I don't know. So I'm going to stay away from them for now until I actually see them beginning to make a return. But for right now, they're not doing it. Forward looking, not backwards. Okay. Yeah, exactly, Billy. That's exactly right. This is about Lamb Weston. So it's about looking forward. And once I got disgruntled with the management performance, that's something that you can't fix unless you change out the management team. They had an opportunity to do that. They got rid of the CEO, but they put the guy in who reported to the CEO. So what have you changed? You didn't change anything. So you had an opportunity, you didn't do it, and so I was out. So there you go. Hakuna Matata. instead of risk. Yeah, it means don't worry. Everything I say matters. Yeah, to somebody anyway. Probably my kids mainly, but yeah, Zig Ziglar. That's probably haven't heard that this week. It's probably, you have to come to an old man show to hear that one. Sorry I brought it. Yeah, it's painful, but man, this is the way I kind of look at it. And I was talking to my wife about this the other night. So let me talk to you guys about it. So I'm gonna buzz back over here to this spreadsheet, and I want to show you what I do here. Historical performance. Okay, so here we go. I'm going to show you guys this. So don't be sorry you brought it up, because what I like to do is I like to not forget the mistakes that I've made as an investor. And so here, let's take a look at this. Since April the 6th of 2021, the portfolio has returned $569,000, let's say. 386,000 of that is unrealized. That means I still own those shares. 50,000 is realized, and that's usually because I'm balancing the tax implications. Dividends, interest, and options. So this is money I've already paid tax on as well, but as income, it is 132,000. So it's time to take a drink. So the point of this is, let me come over here to this side. There are in the how long has this been? Almost 4.5 years that I have started this portfolio. I have invested in 117 companies. And I don't ever want to forget the knowledge that I've gained along the way. Some of these 117 companies have been really good. Some of these 117 companies have been really bad. But at the end of the day, it is a positive thing. So if you take a look at the stocks that have made me more than $500, they have gained about 701,000. The stocks that have lost me more than $500, they have lost $134,000. And so I keep saying at the end of the day, it's not at the end of the day, but currently it is $569,000. Now, if I just shared that number and I said, wow, look at everything that's going on, I'm a super investor, I would be lying to you guys. I've made some great calls and I've made some big mistakes. But what I want to point out to you, and this, I forget who it was earlier that brought up the discussion about, I think it was Ex-Dividend Dad, about watering your flowers and picking your weeds. Don't pick your flowers and water your weeds. So when I look at this, I see I've got, of those 117 companies, 57 of them made me more than $500. I still own 20 of those. When I look at the ones that have lost me more than $500, that I have 10 companies that I've invested in out of those 117 that I've lost more than $500 on. I own still 4 of those. 2 of those are recent. UNH is one, and Elevance Healthcare is another one. And then, I've got some, what else do I have? Stanley Black & Decker, I think, is another one. And I forget the 4th one that I still hold. But, the point is that you want to keep what's winning, and you want to try to weed out what's losing. And so, when, like somebody mentioned Whirlpool earlier, Whirlpool's in these 10 stocks right here. Lamb Weston's in those 10 stocks right there. So it doesn't, I'm not the investor that says I can't sell it if I'm losing money on it. Some people are like that, and I get it. It's hard to sell something when you're down on it. But at the end of the day, why do I keep saying that? But I can't even think of anything else to say. But when I look at it from a rational perspective, if I've got a company that's not performing and I can put that money into a company that is performing, I don't necessarily have to make my money back from the loser. I can make it back from a winner. And so this is my way of keeping track of all of my learning. I can look down through here and tell you why I invested in each one of these 117 companies, and also why, what I missed. Why did I, get this wrong? Or if I did get it wrong, but I didn't get it wrong a lot. I got it wrong 10 times, right? Out of 117. So that's not too bad. So I would encourage you not to forget about the mistakes that you made, because if you forget about them, if you put them off to the side and don't think about them anymore, then you are likely to repeat that mistake. So I wasn't planning on sharing that tonight, and now Fast Eddie is really sorry that he brought that up. Okay, let me get this off the screen. Come back to you guys. Can I pull Simply Safe on Elements? Looking very attractive at these prices for the long-term hold. Yeah, I'll do that for you, Terry. Only for you, though. I'm just joking. I'll do it for anybody, but I just wanted to make you feel wanted, Let me get Simply Safe pulled up, and it is Elements. Okay, here we go. Are you ready for this? Because I'm ready. So, Terry, it looks actually pretty good. So we've got a dividend safety rating of 99, a credit rating, which is very good. Dividend yield is about 2.39%. They let's see what else matters here. The most recent dividend growth is 4.9%. Let's see if there's anything else cool. They reaffirmed on May the 6th, so that's good. 99 is about the best you can get, guys. So payout ratio, well, let's look at this. Their latest dividend growth was 4.9%. 5-year is 15.3 on a per year basis. Look at that dividend growth, man. That's just been crazy. Okay, so let's look at just a couple more things. One is the earnings payout ratio in the low 20s, high teens, low 20s. That's fantastic. They are seeing some pressure on earnings, and that's what's causing them to be at a attractive valuation. Free cash flow per share, though, is going up. That's great. Let's see what else is good here. Sales are kind of flattening out. Return on invested capital was low 10s, let's say, low double digits, and now it's gone to high single digits. Net debt to capital, they basically have more cash than they have debt, and their interest coverage ratio is not that great, but when they could pay off their debt tomorrow, it's not as important as it is for some companies who are highly leveraged. So hopefully that helps. I own Elements. Where is it? Let's take a look at it in here. It's actually the number one stock on my sheet. I'm showing it growing at 27%. The analysts are saying that it's going to grow at 31%. It's basically 56%. Can you guys see that? Probably not. Let me make this bigger. Back in 2021, I guess. Oh, yeah, it's 2021. The year I retired, I had cataract surgery. So I used to wear these big, thick glasses, believe it or not. And now I don't wear glasses at all. And I can see actually pretty well. So I would highly recommend it if you need that. But anyway, Elements Health, buy. I have it as a buy. It's only 1.7% of the portfolio. I might jump into that. I might even lower my UNH, but I'm not sure yet. I just don't want to get overexposed to this category. And then 27%, 31%. Both of these are in, 40% or more undervalued, according to Morningstar. Return on invested capital for United Health Group is better than that high single digit that we saw from Elements. Dividend safety is 99 for Elements, 80 for United Health. So, yeah, I think that's where I'll leave that. So the point is I think Elements looks pretty good, Terry. I may even add to that. But as you know, I don't move very quickly when it comes to the market. But when I do, I move with force. All right, let's come back here. My buddy Russ. Russ says, regarding Whirlpool, free cash flow payout ratio was north of 100. Debt shot up. Dividend was frozen. And interest coverage fell to 2x. All huge red flags. Yeah, absolutely. And I said I was going to look at when I got out of Whirlpool. I'm going to do the same thing with Whirlpool that I did with Lamb Weston. You guys don't need to see all that because it would bore you to tears. It bores me to tears sometimes. Okay, so let's see. I started buying Whirlpool in 2021. That was one of the first companies that I actually bought. And bought all the way through March of 22. Began selling in March of 24 and got completely out in June of 2024. And ended up, let's see, how much did I lose on that? Ended up losing $28,000 on Whirlpool, one of my 10 stocks that didn't do so well, but I don't own them now. I do still track them though. I think they got incredible brands. I think their challenge is they got a lot of challenges. One is the pandemic really pulled forward a lot of sales for them, and that's what I didn't see. And so now they're struggling. They're struggling because they just don't have the market. So, but I didn't see here anything, Russ, about their dividend being cut. Their dividend has been frozen for a long time. So I'll look up Whirlpool here in a second and see if there's anything else. So Russ says, I'm a fan of Zig, especially his truism about all prospects being constantly turned into a single radio station. Whiff 'em. What's in it for me? Absolutely. Yep, that's good stuff. That was something that I learned in a conference I went to as a young whippersnapper. One of the things that I got trained on was how to speak in public. And so if I hadn't done that, I probably wouldn't be here. And you guys are like, well, kind of wish you weren't. All right. Water your flowers with Miracle Grow and water your weeds with Roundup. There you go. Yeah, sometimes the weeds are mixed in with your flowers, though. So it's sometimes you just got to pick them. You can't do a broad brush because if you do, you're probably gonna kill your flowers as well. I don't know. I'm at a loss for more analogies. So anyway, that's good. That's good thought though. KSM 300. All right. Probably the sad part is you could tell me the 10 losers, but could you tell me the 57 winners? Well, I don't know if I could give you all 57 of them, but I can tell you who the biggest ones are. Actually, trying to think. No, I can tell you who my current portfolio biggest winners are easily. Here, let's look though. I'll show you what it looks like on here. The reason it's hard for me is because it doesn't sort on the total return column. It sorts over here, which you can't see on the current holdings, which is the name of the stock column. So I have to look down through here, and but let's take a look just for fun. We'll see that anything that was above 500, we got AbbVie. I made 3,700 on them. Aflac 12,800. Air Products. You guys remember that? That's one that I kept investing in. It dropped really low. I bought some more, and it came back. And so I made 23 grand on them. 16,000 on Google. 1,400 on Altria Group. 800 on American States Water. 35,000 $953 on Amphenol. Guys, I started buying that in, I think it was January or February of this year. It has been a great investment. Sometimes you win and sometimes you lose, but the point is you don't have to be right 100% of the time. You can be wrong some and still be incredibly successful as an investor. And that's where we are. So Archer Daniels Midland, I took that as like an opportunity to make a little bit of money, $5,800 on them. Atmos Energy, this has been one of my best investments. If I just had more invested in them, 19,600. You can see Best Buy is one of my losers, 10,700. So anyway, yeah, I could tell you all of them, but I think it would probably bore you to tears because they're all in here. All of my winners, all of my losers, and all of the ones that I call noise, which is this 50 companies right here. That 50 companies right there. I call that the noise. Those are stocks that I bought and sold and either made less than 500 or lost less than 500 on. And net of all 50 of those investments is a gain of $2,000. So I consider that noise. I like to think about and learn more from my 57 and my 10. So hopefully that doesn't confuse people. Just tell the people to not fall back in love with ex-girlfriends. Yeah, that's something that ex-dividend dad and I talk about quite often. Is sometimes, and this is why this is why I built this spreadsheet, is to try to take some of the emotion out of investing. Sometimes we fall in love with a stock, and we keep going back when she bats those eyes and does a little wink. Maybe the stock goes down and you're like, hey, I think I'm going to go pick some of that up. That's like falling back in love with your ex-girlfriend. A lot of times it's not the best thing. So anyway, thanks for sharing that, ex-dividend dad. And thanks for making me have to explain it. You're never late, Steve. I'm glad you're here. You're just on time. All right. Yeah, that's right, Steve. There is no 100 on Simply Safe Dividends. I was kind of joking when I said you couldn't get much better than that. There is no 100. They go from well, I don't know what their bottom is. I guess it'd be 0, but I don't know of one that is 0. But they could have one. But yeah, 99 is the highest. So Microsoft's a 99. So yeah, 99 for Elements is really, really good. Wow, so that's great, Russ. Whirlpool cut the dividend. I say it's great. It's really awful. Cut the dividend by 49%. I'm glad I sold them when I did. Did I ever look that up? When did I sell them? I won't take you guys through. Oh, yeah, I did. I sold out in June of 24, so I've been gone from them for just a hair over a year. And the reason that I sold them is because I was concerned that the dividend would be cut. It wasn't that I didn't believe in the brands or in the potential for long term, but it just did not look good to me in the short to mid range, and so I moved on from Whirlpool, took my loss, and went on to the house. So let's see real quick here. I think they reported after the market closed today. Wow, they are down 14%. Here, let's take a look. I'll share this with you guys so you know I'm not lying to you. Let me make this a little bigger because a little bigger for the folks in the back. Here we go. They were 97.91 at the close at 4 o'clock. And after hours, which closed about 8 o'clock, they were down to $84, $13.71 per share, 14% down. So, wow, that's amazing. Thanks for sharing that, Russ. That's sad, but it's like the writing was on the wall. I mean, if I saw it, even a blind man could see it, right? 50% of the time, I'm right every time. That's right. And the clock's right twice a day, right? I'm sorry. A stopped clock is right twice a day. All right. Let's see what's going on here. Legendary. Good to see you, man. Finally started a position in Lockheed Martin last week, 424. We'll be buying more while it's on a dip and DCA thereafter. I think that makes sense. They're struggling a little bit. They've got some issues to work out. Let me see where I have them. Lockheed. Well, surely I have missed them. All right. I'm going to have to just go in here and do it with brute force because my eyes are playing tricks on me, I guess. Yeah, they were. So it is the 18th rated stock in my my spreadsheet. So 18. Yeah. So, but I think they are they're a fine stock. I'm showing them with a potential of 14% growth over the next year. Analysts are saying 16%. They've got a wide moat. They're about 20% discount. The return on invested capital is about 19%. They have a huge backlog. You could do much worse than Lockheed Martin. So Legendary, I think that is a good move. I love the DCA part of that because there's going to be times when it lags and there's going to be times when it's overvalued. But if you DCA, you're going to be in that just right. All right, let's see. Yeah, Billy's also got some Lockheed Martin going on and Elevance Healthcare. I think Elevance is actually my, what did I say it was? Is that number one? Yeah, it's my number one stock to buy at the moment. And why is that? It's undervalued. It's let me see what it's. Yeah, it's like 44% undervalued according to Morningstar. And there's all this uncertainty around it, but it doesn't have the same fraud baggage that United Health Group has. So I think if you're wanting to play in this market, I think Elevance Health is the right way to do that. Billy, they have a 2.4% yield. I thought you were a higher yield guy, but it's okay, because I kind of like that growth too. That growth feels pretty good, So, oh, this is good, Michael. You should write this. You could either write a book or write a song about this. Never fall in love with something that can't love you back. That's pretty good. It is an inanimate object. Yeah, I think I'm going to pass on that. All right. Yeah, that's right, Hassan. Whirlpool is in a lot of debt. They're in a lot of trouble. So I think, to be honest with you, I think cutting the dividends is the right thing to do for the company, but it's not good for investors. Whirlpool to $70. It could be. And here's another thought of the day. Everything is worth something. If it's not bankrupt, everything is worth something. So what is the price that you would be willing to buy Whirlpool? Let me throw that out at you. What is $70 the right price? If it was $70 tomorrow, would you buy any? If it was $60, would you buy it? If it was $50, would you buy it? At what point would you buy Whirlpool? Let me know what you think. No, I haven't done the SSD news because I saw you did it last night, Russ, and I didn't want to double do that, because we have a lot of similar folks on here. So, but if you guys want to go through the SSD or the Simply Safe dividend news, I'll be glad to do that. But I just didn't want to double up, Russ, what you had already done. What are my predictions on the UNH earnings in the morning? That's a great question. United Health Group, I think, it could go both ways, right? But if you had a gun to my head and said, predict their earnings, I think we are going to see them have some kind of write-off. I know that they had one last time. I think they're going to do it again. And I don't think they're going to have great earnings. They'll probably be close to the expectations, because if they've got a decent investor relations group, they will be working with the analysts saying, hey, don't forget about this. Don't forget, these things are going to impact earnings, and they, can get the analysts to where they need to be. So I'm not saying that they're going to miss the analyst predictions for them, but I do think that they are going to lag where they've been in the past. So, I don't think the stock's going to do well tomorrow. I hope to be wrong. I love it when I'm wrong, when I think things are not going to be so good and they turn out great. I love being wrong in that case. But I'm not looking for great things from UNH tomorrow. But we'll just have to see. Yeah, that's right. News is your thing, Russ. UNH guidance will probably be more important than earnings. Yeah, that's right, Michael. And I don't know that they're going to be able to give us any guidance on the investigation, on anything that's going on in the new administration. I don't think they're going to be able to give us too much. I think they may come out and say that they can't. I don't know if they're going to have confidence in what they give us. So. Who knows? Yes, I do have bees, and the bees are doing great. I think I was told you last week I lost 2 hives, but the remaining hives are all looking really strong. There are hardly any flowers out now because it's just that time of the year. Here in Alabama, in the middle of the summer through August, is just what's called the dearth, DEARTH, the dearth for bees here. And so since I've pulled my honey, I went ahead and began to feed them with what's called a simple syrup. So, my hope is to get them strong, so they can overwinter well, and we can do this all again next year. And I'm looking to and I may talk about this in a future broadcast, but I'm looking at growing my own queens next year. That, my friends, is fascinating. Yeah, I hear you, Billy. I lost quite a bit on it as well. So Billy's not buying Whirlpool at any price because he's lost too much on it. I'm kind of with you on that. They are still in the spreadsheet, but yeah, I hear you, man. It's a sore spot, and like I say, I love to keep looking at the mistakes that I've made so that I don't make them again. So I don't know. I don't think I'll be jumping into Whirlpool anytime soon. Yeah, Michael says bees have a funny way of showing their love. They certainly do that. That's why we wear all that protective equipment. So yeah, if no guidance, they'll get hammered. Yeah, and who was it? I think it was somebody last week came out and pulled their guidance. I forget who that was. If anybody remembers, let me know. But I don't know that and they may not pull their guidance. They may have confidence in their future. But I'm sitting here going, man, they've got a lawsuit coming on. Of course, that would probably be considered, not what do they call that, where they exclude things from earnings, operational. So that would not be in their operating earnings. It would be in their GAAP earnings, but not their operating earnings. So they may have, they may have some view into the future. I'm just guessing. I don't really know. But my guess is they're gonna struggle until they get some of this stuff kind of wrapped up, some of this uncertainty. Here's what I think. I'm holding United Health Group. I have how much of them do I have? Let's take a look. I have 200 shares of United Health Group for a value of. It froze up. I don't understand. Huh. My spreadsheet froze up. There we go. It's back. For a value of United Health Group is $56,000. So I've got $56,000 invested in United Health Group. And I'm holding that. I'm not getting rid of that. I'm not adding to it. But I think at some point when this uncertainty goes away, and it might not even be in the next year, it might be 2 years from now. But once this uncertainty kind of gets out of the way, I think United Health Group is going to come back. It may not go back to the highs that it had, but it is certainly going to come back to more than it is today. I think this uncertainty is really hurting them. Let's see. Yeah, Michael says he's going shopping if it gets hammered. So Billy says think positive. So I'm positive it's going to be a rough day for UNH tomorrow. But who knows? I don't know. Is UNH before or after the bell? I think it's typically before the bell. But if you want to know for sure, let's go to UNH. Oh, actually, it's in my spreadsheet. Believe it or not. Let's see if it's this right here. Well, we'll go to my handy dandy spreadsheet. See if I put it in here or if it's way over here. It's in the catacombs of the spreadsheet. Tip ranks. Yeah, here we go. That was UNH, right? TU United Health Group. There we go. Before the open. Yep, it is before the open on July 29th. So tomorrow before the open. So when you get up in the morning, you'll have something to look forward to. Can I do BNPL? Help me with that. I don't know. Probably should know what that is, but BNPL on UNH. What does that mean? I don't know. I'm not following you, Michael. I usually track with you, but I'm not there with you. UNH, the 3M of 2025. Yeah, it is. It's been a rough year. I mean, I was way up on UNH, and then all of a sudden I was way down on UNH. Oh, I got you. Yeah. Buy now, pay later. So it'd be, you want to put it on the layaway plan, huh? Yeah, I don't know. It's going to be a rough, I think it's going to be rough, but if it's not, and they come out with some really positive news, I'm going to be one of the happiest guys tomorrow. So It's not that I'm hoping they have bad news, but I'm just afraid that it's not going to be positive. So we'll just have to see. All right, guys. Well, we are right at the end. We have 12 seconds, 11, 10. And so I'm going to go ahead and get off here, guys. I appreciate your participation. I thought it was a fun show, and I look forward to seeing you guys again next week. Let's if you're not part of the Discord, get in there. We'll talk about UNH in there tomorrow. So we'll see what happens to them. So with that, guys, I'm going to sign off, and I will see you on the next one.